Okay, Ladybug. I've unplugged everything from the computer but the bare minimum, so I'm not using multiple monitors right now. Something keeps interrupting my videos from recording. So I've unplugged everything and I'm just using the laptop, my mouse, and headset. And hopefully everything will work out great. Okay. So right now we currently have just the main ribbon bounce system. Okay. Green does not mean buy. Red does not mean sell. White does not mean neutral, buy, or sell. Okay. These are moving averages. Each, I tried to get them as solid colors, but it wasn't something I could pull off. Okay. So it's just multiple lines. Now, pocket options. Let's take your 50 moving average on pocket options. All right. And I believe we have it set for EMA, which is exponential moving average. That just means it moves a little bit faster in direction wise over the last 50 candles. If it was a SMA, it just means it would smooth things out over the last 50 candles to give you an idea of where the candles are going. Now, pocket options only allows where you would put that 50 for the input section only allows you to knock it up to 250. All right. Can't go any higher than that. And so you could pull off this white line with multiple things, but you could never pull this one and this one off. These are very much higher. This one's like up into the 300s, this one's into the 400s. Okay, so we really know what the direction is long term, like very long term. Okay. And most people aren't using something like this. They're using more shorter ones like this. Most people will usually use 200 or less. All right. Now, let's go ahead and we're going to treat this one as if we were trading long, okay, like regular markets. And then the next step down or the next one will be applying this to pocket options. Okay. But we're going to go just how to use this for the regular markets, but just so you get a base idea of how these lines work. And so I'm going to zoom in. Okay. Let's go ahead and, oh, no, don't want to do that. There we go. So we will start here. Okay. So when you have candles that are within these lines, we do not take any trades. Okay. When it comes to long trading. Now, once it finally broke through, we still do not take a trade. We wait until we have confirmation that the white lines have finally come through the main sections, because we know it's going to go down now. Now, it doesn't happen too often. Sometimes it'll just trade sideways in a way, but most likely it's coming down, so we know. Now, what a lot of traders will do is they will wait for the candles to come back to retest that white line. All right. So, and once they do, they'll put in their trade here, okay, because it got retested. So they might have got their trade in here so once they seen it was bouncing back. Or let's say they waited till that candle closed and then went for the red. And they would set their stop loss for right up here. Okay. As it comes down now, if their stop loss is this is one of the things about pocket options. Pocket options doesn't allow you to have a moving stop loss. You have to manually input your new stop loss amount every single time. And where MetaTrader here in front of you and NinjaTrader, you can put your stop loss in and it will create a line. And then you can just click that line and move it where you want it. So you could follow along. All right. And so what you would do is you have your stop loss come following down. Boom. Okay. Now some people, now this one here, it would have closed out, but if you didn't move your stop loss, you would have came down and boom, and you would have lost a little bit of money, not a lot, compared to the win. All right, so since it's not crossing and we get another close, you get in here and then you could ride it down. So here it comes all the way down, boom, boom, and you could get out right in here if you wanted to, because now you see it's doing. So yeah, you lost a little bit of money there, but you gained much more here, you know. And this is why a lot of people like to do stop loss because now they can follow the trend down and then if and walk away even, because like if you had here, it stopped and then it came down, your stop loss would automatically move. So, once it passed here, like let's say this one came, now you're working on this one, your stop loss moved to here, and boom, you came to this, now your stop loss moved to here. And as soon as this candle came bouncing up, it would automatically close the trade out, so you still won. Um, but if you're gonna stay in long, what a lot of people will do is make sure that they're winning. They would, even if they didn't really get much money, they would set the stop loss at a section to where it covers all their transaction fees. Okay. So you could have stayed in all the way to here. But again, once it starts crossing into this, you don't have a trade in, you don't take a trade because there's too much, especially when everything starts joining here. Here we have an M-shaped pattern, so most likely the market's going to go down. And as you can see, it did do that. So we'd wait. Here's the retest. So a lot of traders would get in here and ride this all the way down. Boom. And they would get out somewhere in here. Mhm. So it comes, boom, and got tested at the line. This is the bounce. This is why I prefer 5 minutes. So when it hit here, bounce, take a 5 minute. 1, 2, 3, 4, 5, win. Came down, came up, it bounced. Yeah, not too sure if it's going to go up or not, but you could just avoid that. But once it comes down, gets past here because it retested again and failed. It tested, failed, tested, failed, tested, failed. So you can get in here and ride this down for 5 minutes. 1, 2, we'll just say here 1, 2, 3, 4, 5. So you would have barely won, but if you would have got in, if you got in on this one, that was a win. Alright, came here, it bounced. 1, 2, 3, 4, 5. All right, you would have won, barely, but you won. And then once it crosses over, we don't take any trades unless it bounced. So you could go for a trade for going down 5 minutes, and you could do 1, 2, 3, 4, 5. That was your win. We have a W shape. So when we get a W, usually the market will continue going up. But it's in a main area, so we would avoid taking any trades right here, unless we had more confirmation on something, which I have for you. So once across, came down, because this is consolidation. This is actually consolidation as well. Okay. This is one of those where it just long trading can make your life a lot more easier, but currently you don't have the tools to make that happen. Pocket options is a great way to build your money up. and then move it over to the regular markets, and then move over to better equipment, software, so to speak, like NinjaTrader 8, so you can be a better trader. A lot of people will always tell you, well, all you need is a laptop. That's true. That's all you need if you know what you're doing. But if you have the extra tools, then you don't have to trade as much because you won't get as many losses, and that's the goal, to take less trades. We want more quality trades. Okay. So like here, where it came down, it bounced, it went up 5 minutes. 1, 2, 3, 4, 5. Would have won. Now it came down and it bounced off these two main lines. So that's a good sign. 1, 2, 3, 4, 5. Or even if 1 minute. And that's something you could be doing, is you could be doing your 1 minute trades where just before the candle closed, it bounced. Well, just before the candle, that could have been a tie, possibly a win. It went up, came down, bounced. Take your trade just before this candle closes. So let me zoom in on it. There we go. So just before this candle closes. So on pocket options, when it's counting down to 1. So, and you wouldn't want to use, now you could set pocket options up where you have two charts. You have the 15-second one and do the exact same charting system, but on a 1 minute. So you can count when this candle's going to close. And I'll show you how to do that on another video. So just before this candle closes, you would put in trade. Now you may tie out or just barely win. As it went up, it came down, it bounced. So boom. So just before this candle closes, we put a trade, you would have won. So we come down, it bounced. Just before this candle closes, you put in a trade for 1 minute going up, and you would have won. We wait, boom, boom, boom. It came down, it bounced. It's a good long candle. So just before this candle closes, we open a trade for going up, and you would have won for 1 minute. Now right here, we had a bounce, but it's kind of like a doji candle. Um, it's not very big, so I wouldn't take a trade on that. I want good movement on the bounce. You see, and as you can see, it still came down, and then it went up. So if you were doing a 1 minute trade, you'd want to do it. Yes, you would have lost this trade, but still, it was a good move. And that's why, for me, I'm more of a 5 minute. Boom, 5. 1, 2, 3, 4, 5. You see, and I still would have lost that trade, but I had a better chance. But now, this is one of the things about why long trading is better if you're doing small movements. You could say, boom, okay, we got it. And we got our movement. Your stop loss is down here where the candle's low was. And if you got in and out right here, you could made a couple bucks right there with doing a stop loss, following stop loss. And that's one of the reasons why in the future you're going to want to move over to doing that. So, because a lot of times you would win if you just did more time and had more control of when to get in and out of a trade. But pocket options doesn't allow you to do that on the regular what you're doing. Uh, you can do it on the regular markets, but again, they don't. You can't just move the line for your stop loss on pocket options without having to input the numbers. So now we got it. Right now we can see though that we've now gone into consolidation. Just by looking from here to here is consolidation. All right, now if you wanted to, you could have took a trade here and you would have lost, and then you're in, so you'd want to wait for a real good breakout. Okay, so we wouldn't even take any trades here. There's nothing good telling us anything. It's coming down to these lines. We had a break. You could take a trade, you'd lose, and then it came down and broke, and you could take a trade and lose, but then see where it's going. This is why having 5 minute trades could really help you. Like you're not going to win them all. And that's what the money management is, and how many chances to get it right. And you only need twice, two wins out of 11 chances. By doing this kind of system setup, you should always be able to get your two wins just with these three things. And if you had multiple charts going, you could then really start to be a little bit more pickier about your trades because you're not waiting as long for them. When you're only working off one chart, things can be taking a long time before they get to a particular area. Like right here, boom, it took 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23, 24, 25, 26. 26 minutes from this trade to this trade. You know, and then let's say if you had a longer one, look at how many minutes we have here before you had any real bounce. You know, and let's keep going. See how everything's closing in? We do not want to take any trades because the candles are below the white line. When candles are within these lines, we don't take any trades. We only take trades when the candles are outside of the line. So right here it came out. It's going to come back up and do a retest. So, and there was the bounce. So just before that candle closes, you put a trade in for 1 minute going down. You would have won. Coming back up for a bounce, but this is small move. If that was it and it's already coming back up, we wouldn't want to take any trades. This is obviously consolidation areas. So let's wait for it to come back out. It's coming up, it bounced. It had a nice good long candle for down as a bounce. So you get your trade in 1 second before it closes. And then right here, 1 minute down. The reason why we do 1 second before the candle closes is, let's say this candle closes, and then by the time you get your trade in on here, this candle may have already come down to here. And then by the time the candle closes, it's up over here, or a doji. So you would have lost. So this is why we put our candle in, or 1 second before it closes. This way we can capture any movement that was here. So we're coming back up. Now, as you can see, we have a bounce you may have lost. But again, everything's so close together, you really don't want to be taking any trades when it's close. You want these bands to be far apart. Okay? So right here, I think that kind of explains kind of how the ribbon works for you to be able to take your 1 minute trades or 5 minute trades. But you obviously want to do 1 minute. It's more gratifying for you. So here we came up, we come down, we have the red, it hit, it bounced. It's a good sized candle. Just before that candle closes, you take a trade and you would have won. Comes back up, it down, bounces. Just before it closes, you put in a trade for 1 minute, going up, boom, you win. As it comes down, it bounced. You put in a 1 minute trade just before it closes. It goes up and you win. Now it came down. It did not bounce off of here, so we wouldn't take a trade going up. All right, so number for you, I prefer you not to be trading anytime these candles are within the main scheme of things. All right, once you get a little bit better at it, then maybe you can start taking trades within these lines. But for right now, you really only want to be taking trades off this white line. Oh, I'll close that. So let's see. As you get better, you'll be able to recognize things. But I'm just telling you this because it's a safer move for you in the beginning. So as you can see, we have down. It finally crossed over. That was the retest right here. And it failed. Given it didn't hit the lines, but I would have taken the trade. But if you weren't sure, you'd have had to wait to all this. This is quite a bit of time in minutes. And then once it got to here, it got the little one down, bounced, came down, lost, still bounced. So I would have put in another trade right there because that's a good size candle, you know. But you'll get the idea. So that's going to be the end of this video for just the ribbon bounce. And again, green doesn't mean buy, red doesn't mean sell, white doesn't mean neutral or buy or sell. These are just moving averages. And two of them, this one's you could do with pocket options. Not too bad. It's less than 100 moving average, more than a 50 moving average. But these are the extreme ones. Like if these are crossing, the market's changing. It's doing something, whether it's consolidating, getting ready to go up or go down. Okay. But knowing that where this line is above or below these lines really lets us know which way the market's going. Only in a little while, well, like right here where it's crossing, we don't really know what it's doing. You know, so right here, when it's crossing, we have an idea it's going down, but we don't know for sure until it crosses. You know, like right here, it's joining. We know there's good movement going up, so someone could capitalize. We got this wide, the reds went above, but like right here where everything's so close, we're just consolidating. The market's figuring out where it's going. So we don't look for those kinds of moves. We look for moves where the ribbons look like this. Okay? Let's see if we can find another section. Like right here, we wouldn't do anything. There's not enough of where the market's going. But once we know it's crossing, we know the market's going down. All right. Now, a lot of people, they could go here for retesting, but a lot of people would also be safer once it crosses. Here's the retest, and then make their trade for going down. Okay, that'll be the end for just this.